Guys, this is Rich Klein from the Diamond Law Group. What we're going to cover today is how to review a loan package. So let's begin. Whenever you get to a closing, you'll see the buyer's attorney skip through the first couple of pages of the loan package. As we see here, it's 68 pages. It sounds like a lot at the beginning though, moving right along. These are just instructions to the buyer's attorney or the bank attorney. It doesn't really apply to the transaction, so you could just skip all of these instructional pages at the beginning. All right. When you finally get to an actual document, out of everything we're going to cover today, there's really only 3 pieces of paper that are really important. So we'll be sure to highlight that throughout our discussion. Everything else, for the most part, has been signed already by the borrower, or at least e-signed. For whatever reason, even with today's day and age and technology, they still need a wet copy or a hard copy, as they refer to it as. And most of it is just ancillary or immaterial to the actual transaction. First document we have here is a name affidavit. What this document would say is that any variations on the borrower's credit report would be stated here. Sometimes you have names, for instance, I go by Rich Klein, but my God-given name is Richard Klein, so you might see those variations here. Oftentimes you'll have a middle name or a middle initial. You could also potentially have juniors. For some individuals who are married or divorced, you might see those names here as well. And they would just sign here, stating that they're one and the same. They refer to this also as an AKA affidavit. And the next document is a compliance agreement. To summarize this document, the loan may be sold to a different bank over the term, sometimes usually 30 years, or the bank may become a different bank over time, as we've seen in recent years. And this says that the borrower agrees to comply with whoever the loan is going to be sold to or may become in the future. They have to give you, the new bank has to give you ample notice of their servicing. They have to change any escrow accounts, and they cannot change any material terms, such as namely the interest rate. This affidavit of occupancy says that this is a primary residence and that the borrower is going to be moving in within 60 days of the closing. You qualify for different types of loans, so the bank wants to make sure that this is under a primary residence. This is a tax map information that the title closer would fill out, so that way the escrows are correct. This property in particular is for Suffolk County, and I'll show you a little bit later on why that's relevant. Again, the title closer would complete this for money laundering and anti-terrorism purposes. They would complete the borrower's identification information below. This is the famous closing disclosure. We have another course that we'll be filming that will review closing costs, so I'm not going to dive into that wonderful world right now. However, the closing disclosure is part of the final closing documents as well. I said at the beginning that there were 3 important documents that we needed to review. This being the first one, this is the promissory note. This is dated May 17th of this year. States that this borrower agrees to pay whichever bank it is, whatever loan amount it is, at whatever interest rate. All right, so this is literally the borrower's personal guarantee to repay the debt. The first payment is going to be July 1st. Again, our closing date was May 17th. The reason for that is something known as interim interest. And what that says is that interest is collected from the date of closing through the end of the month, that being the month of May. The entire month of June goes by and interest accrues and then is due retroactively July 1st. They will continue to make their payments the first of every single month for 30 years. It doesn't specifically say 30 years here, but just doing simple math, 2052 sounds like a made up year. but that's how long the term is. You also note, pun intended, that it doesn't say specifically anything having to do with the interest rate being fixed. If it was adjustable, there would be specific information about that in here as well. All right, so here's everything having to do with the interest. Next, this is the amount of the monthly payment would go over here. And this amount on here is not the actual mortgage payment. It is just the reflection of principal and interest. If it is a fixed rate note, the principal and interest amount will not change. What will change inherently within the principal and interest amount that is again fixed is how much is applied towards interest and how much is applied towards principal. At the very beginning of the loan, most of it is interest. There will be an amortization schedule later on that explains that more thoroughly. For now, our purposes, when we go over this with the borrower, we explain to them that this is their mortgage payment reflecting principal and interest only. It doesn't have anything having to do with escrows such as taxes and insurance, which we'll go over later on. This is where they would put the address of where the payment would be made, though most people sign up for auto pay. If you wanted to send in a check, this is the address to do so. Borrowers traditionally do not have a prepayment penalty, so I always jokingly suggest that they go out and win lotto and want to pay this off literally as soon as we close. There's zero prepayment penalty for doing so. The borrower then has 15 days to get their payment in, otherwise they tack on a 4% penalty of the principal and interest amount. The balance of the document we summarize because it talks about default, and that is to say if you pay, you could stay. If you don't, then you won't. And the reason why I feel comfortable summarizing it is if you look at the bottom here, this is a New York fixed rate note, single family Fannie Mae Freddie Mac uniform instrument. It was originally drafted in 2001. So for literally over 20 years, this exact same promissory note has been utilized, irrespective of which bank, what your loan amount is, what your interest rate is, or where you're purchasing the property. Everyone signs the exact same version. All right. And then the borrowers would sign down here. The allonge says that there are no other loans and that this is going to be in first position. All right, there's no other secret loans between the parties or any of the loans taken out at the time of closing, such as a HELOC or other secondary financing. Next brings us to the second most important document. This is the mortgage. What this document does is notify the world that the borrower is taking out this money today. The borrower then pays a mortgage tax. In Nassau and Suffolk County, it's 0.8 of 1% less $30. That's for the right to borrow this sum of money in the state of New York. It then gets recorded against the property, for which you also have to pay recording fees, which are roughly around $750. It then becomes public record. If the buyer tries to sell the property or refinance, whichever title company is utilized at that time would find this of record, and they would then need to pay off whatever is due at that time. The second thing is it goes into 10 pages of the foreclosure process. And the rationale behind this is the borrower is borrowing money, the collateral for which is the property itself. If the borrower fails to repay that debt, the bank wants to recoup however much they possibly can through a foreclosure sale of the actual property itself. All right. Again, it's 10 pages long. That basically explains that. Next, we have a 1 to 4 family rider that says that it gets attached to the actual mortgage itself, and it just specifies the type of property that the mortgage is being attached to. This is the first payment coupon. This is the third most important document. This shows the borrower for the first time what their payment's going to be. The principal and interest amount that was revealed on our promissory note, that does not change. The estimated taxes, that does fluctuate on an annual basis. Homeowners insurance, also known as hazard insurance, gets paid as well as any other escrows that may be applied to this transaction. Again, then it reiterates the first payment date. It would state the outstanding principal balance as well as the interest rate. There is no prepayment penalty. All right. If the bank, for whatever reason, fails to send the first payment information, you can use these payment stubs as well that the bank conveniently gives to the borrowers at the time of closing. Though out of the wonderful mortgage process, the one thing that they'll make real easy for your borrower is telling them how to pay in a timely fashion. Next is our initial escrow account disclosure. This would state how much is being put into the borrower's account, again, factored into their closing costs. The first payment, again, would be July 1st. This payment would go into the account. If there was anything dispersed, for instance, in this transaction, this mortgage insurance, that would be paid out here, and the balance would go up proportionately. That trend is going to continue up until December of 2022, when the bank will pay the taxes on the borrower's behalf. Part of the problem, though, is that this is just an estimate of what the activity for the payments for the taxes should be. We don't know what the 2022 taxes in December will be. That's why the bank has what they refer to as a cushion right here, which is a surplus amount that they keep in the account at all times, roughly 2 months of whatever the escrow contribution is. So that usually when these taxes are higher than they anticipated, they have some money to pay on behalf of the borrower. And you could see that we closed in May, they would pay the homeowner's insurance as well. One of the very most common misconceptions from homeowners is they have to pay their homeowner's insurance up front. Then they have a question as to why they then need to contribute to their mortgage payments that includes their homeowner's escrow. The reason for that is the bank always needs at least 12 months to be prepaid. So again, we close in May, the first payment, and you pay at that time for 12 months upfront for your homeowner's insurance. The bank then collects a couple of months in escrow as a buffer. The first payment is in July. That means, in essence, 2 months have gone by where the homeowner's insurance would have been paid. So the 12 months of prepayment we had goes down to 10, and the escrow account now has a couple of months of homeowner's insurance. When you go through the entire year, the prepayment of homeowner's insurance goes all the way down to 0 when we get to 12 months. However, instead of having the homeowner pay for it again, the borrower has, in essence, every single month contributed to their escrow account in order for the homeowner's insurance to be paid. So by way of example, if the homeowner's insurance costs $1,200 annually, $1,200 divided by 12 months is $100 per month. If we scroll back up here to our first payment coupon, you would see that the estimated hazard insurance would be $100 that would be contributed every single month. So that way, when you get to here, it'd be 100, 200, 300, all the way through. When you get to 1,200, the bank would automatically have enough money to pay that again. The question then becomes, well, when do I get all this money back that I'm prepaying? The answer is when you sell. Just like if you sold your car, for our purposes, this closing took place on May 17th, and you prepaid your car insurance for the month, you would contact your car insurance and say, hey, I sold my car today, I'm due back 14 days worth of interest. The problem is for your house, because it's such an important asset, the bank only has one option for your insurance, and that's on an annual basis. So if you sold your home, you would notify your insurance carrier that you've done so, and then receive a refund from whatever the closing date is through whenever the original insurance payment was. All right. So you have to pay your insurance beforehand, and then you contribute on a monthly basis to your escrow account. So that way, within 1 year, when it is due, the bank will automatically disperse that on your behalf. All right. And again, the first payment would be here, which includes the principal and interest amount that was on our promissory note. And then this is the escrow contribution, which in this instance includes the homeowner's insurance, the mortgage insurance, as well as the property taxes. All right. If you were in Nassau County, it would include 2 different taxes, the town and the school, and then there's other village and city considerations as well. This is that the next documentation is that the bank used the borrower's tax return in order to determine whether or not the borrower was credit worthy. You have to keep the house insured in the state of New York. All right. If you change your coverage after you are in contract, after you have closed, then you need to notify your bank of who the new carrier is. You actually need to pay for your next policy. Then your old will be reimbursed to you retroactively, so as to avoid any lapse in coverage, because God forbid, knock on wood, anything happens during that time frame, you can't have any exposure. And then this is who you would notify if you change your homeowner's insurance in the future. There has to be a flood determination. just because you're not in a flood zone at the time of your purchase doesn't necessarily guarantee that'll be the case. That happened after Hurricane Sandy, unfortunately, where prior owners who were never in a flood zone now suddenly found themselves within a flood zone. And then the banks would notify them that they had to purchase flood insurance, and the homeowners disputed that fact and said, well, you can't force this. The answer is FEMA makes that determination. It has nothing to do with your bank. And if FEMA determines that you have to pay for flood insurance, guess what? You have to pay for it. This is the amortization schedule. I left in a couple of the numbers so you could see how this functions. At the very beginning, this is the payment amount. You can see right here that the principal portion of the payment amount is not all too high, whereas the interest is the vast majority of it. The balance then goes down proportionately, and this is the monthly mortgage insurance, which will come off after the loan to value gets to 78%. People say 80%. You can apply for it at 80% and they can potentially take it off, but if you do nothing else, when it gets to 78%, it'll come off. And here's the resulting loan to value, again, 30 years, 2022. If you skip all the way ahead to 2052, 30 years later, you can see the payment is the same, except they took out the PMI because there's no PMI. The interest is the very vast majority of the payment, and there's relatively no interest, and there's no loan to value, all right? Again, this is 7 pages on an amortization schedule, 30 years and 360 payments. They utilize your credit score on this. There would be 3 different versions of this for all the different bureaus, all right? And then they give you the rankings here depending on what the different credit agencies are. The borrower certification. The borrower has had the pleasure of providing bank statements, tax returns, pay stubs, things of that nature, their social security number for their credit score, and then they have to continually update those items. The borrower then attests to, at the time of closing, that everything they provided thus far has been truthful and accurate. Though that's kind of self-serving, because if they were lying before, they'd lie in the document saying they weren't lying, but that's neither here nor there. Next, we have the equal credit opportunity. If you feel you were discriminated against based upon all of the different factors here, you can contact the FTC and they will investigate. If you do not pay for your mortgage, guess what they will do to your credit? Obviously damage it negatively. Due to COVID here, we're attesting to the fact that we don't have any loans in forbearance, and we haven't been notified of any layoff or furlough or reduction in staff, and that COVID hasn't negatively impacted your ability to repay the debt. Next, this is a boilerplate loan package that we're utilizing here. And obviously they do things differently in the rest of the country, including potentially signing your loan documents, but also being notified that you have to conduct a home inspection. Obviously in the state of New York, by the time you get to the closing table, me telling you to conduct the home inspection is something that you obviously should have done a long time ago, traditionally before you even sign the contract. Next, this is a blueprint about how to commit loan fraud, which is nice of them, HUD, to lay out for us, and you're attesting to the fact that you haven't participated in any of these bad things. Next, this compares an FHA loan to conventional financing, though by the time you get to the closing table, you would have already needed to acknowledge this, and this runs through all the different comparisons so that way you can make an educated decision. One of the most uncommon things that borrowers or homeowners don't realize, potentially agents, maybe even loan officers, is that when you take out an FHA loan, it's actually assumable by the next person who purchases your home. So for instance, if somebody purchased their home and they have an outstanding balance at 2%, 3%, 4%, or anything less than it is nowadays, as of this filming of June 23rd of 2022, rates now just hit 6%. If you have an FHA loan, that is something that can be assumable by your borrower. And they would need to obviously qualify, but they would be able to take over your actual loan interest rate at that time, all right? So that's something I'm sure we'll be seeing more of in the near future. Lead-based paint, the bank wants to notify you that they stopped manufacturing it in 1978, and you have the right to conduct an inspection. That's something that your agents actually have to disclose to you as well. The remediation for lead-based paint is actually painting over it. You don't remove it like you would some type of other hazards such as asbestos. So unless the house hasn't been painted since 1978, it's generally not a major concern. This notifies you that this is an FHA transaction and the parties are unfamiliar with one another prior to. It's what they refer to as an arm's length transaction. Generally, by the time that you get to the closing table, this would already have had been signed by both parties. And then they have the disclosure that the property needed to appraise for a certain amount. Again, this is something that would have been acknowledged by the parties prior to. Next, HUD wants us to make sure that this property is not going to be used as a hotel or other transient use. It's used for primary residence. Again, New York State is telling us we need to keep the house insured, which we already know, very similar to car insurance. This is one of the very few documents that the seller signs that they're the owners of the property and that there's at least one smoke detector on every floor. Sometimes it'll say carbon monoxide detector as well. This is New York State's addendum to the loan application, which in bold capital letters, they really mean it. It is a crime to intentionally falsify information on this loan application. Though again, if you were going to lie in your loan application, you'd probably lie in this document too. So it's a little self-serving. Nonetheless, loan fraud is obviously frowned upon by the US government as well as New York State. It says that this person is not in a flood zone as of now, as we went over before. That doesn't mean that in the future they will not be considered to be in a flood zone. This is the application for the FHA. All right, again, it's ironic that one of the first documents that the borrower would sign is one of the last. Nonetheless, they still have the pleasure of re-signing the FHA document. For some reason, this is one of the few documents where the borrower actually signs twice. They like to confuse things and mix it up every now and then. So that is our FHA application. Next is an IRS document. This is the 4506. What this document says is that the bank can pull the borrower's tax returns, all right? And you say, well, why would they possibly need to do this? Well, the thought process is that the borrower may have defrauded the bank by filing a higher tax return for what they actually earned for income for qualification purposes. Then, because they didn't need to pay anything, the taxes may not be due at the time of filing, the borrower may then amend their return and apologize to the IRS. And then lo and behold, they can't make the mortgage payments. The bank wants to make sure that the tax return that the IRS has of record is the same one that they use to qualify the loan. That's why this document here expires after 120 days, because if you look at the sliding scale of default for fraud purposes, at least, usually it'll be one of the first, second, or third payments, and that's why they have this document re-signed at closing. All right, and again, it's a standard IRS form. Speaking of which, we have the W-9. This document allows the bank to verify the social security numbers. It also allows the bank to file a 1098, so that way the borrower can deduct the interest and taxes on their loan. This is generally received before February 1st of the following year. Moving along, this is our new application. At the bottom of these documents, it generally says when they were drafted. And this one in particular is a recent document relatively that was drafted in January of 2021. It used to be a 4 or 5 page document. Now they made it easier by doubling the amount of questions and pages that it needs to be, and that is per borrower. So you can expect to see 2 of these at the actual closing, just verifying how much the borrower had in terms of assets and other income. They go into other information such as demographics and other questions about having to do with whether or not you defaulted, if you've ever been in foreclosure, if you've ever declared bankruptcy, any type of military service. Then they go into demographic information. That again, this is a federal law. It's not something new, that they want to make sure that you're not being discriminated against based upon all of these factors down here. All right. So that concludes the loan process. As you can see, didn't take all too long for us to go over it. In general, the closing really should take no more than a half an hour. provided everyone's on time and there's no surprise walkthrough issues. To round out the closing, what we would then do is go over transfer documents from the seller. We go over the closing documents, and those will be other courses that we go over as well, so that way you have a transparent understanding of how a closing should be conducted. For any borrowers that are watching this, if you have any questions, you can certainly reach out to us. Our contact information is below. For any agents that sometimes attend closings and want to know what's happening, if you have any questions, we'd be more than happy to assist as well. For any attorneys, brand new attorneys that want to learn how to conduct the closing, best thing I would suggest is you could email me and I'll send you the blank documents that we just went over, the loan documents. Find somebody to just sit there and go through the documents and get all those nerves out of the way. So that way, when you're in front of an actual client, it'll be like clockwork. In reality, it's the same documents that are used every single closing that have been used for quite some time. So as long as you can get the basics down of how escrow functions, which again, during our closing course, continuing education course, we'll be sure to really go through that with a fine-tooth comb to make sure that you understand the interest rate needs to be correct, the loan amount needs to be correct, the term, and then the names of the borrowers. After that, everything else is pretty much immaterial, that the borrower is already pre-signed. If you hear or have an inclination that your borrower may want to read everything beforehand, that certainly is their right. And what I would suggest is obtaining a copy of the loan documents from your lender's attorney in advance, sending it to your borrower to see if they have any questions. Because in reality, you can't change any of these documents, or the bank attorney is not going to give you the money. And it's unfair to all the other parties to have one party sit there and literally read through over 100 pages to make sure that they understand everything. They do have the right to review it, but there's a certain place and time, and not necessarily at the closing. So that should really be avoided. If the borrower doesn't have a trust level with their attorney to review the documents, then that's a bigger problem in and of itself, in my professional opinion. All right. Again, hope you guys enjoyed this continuing education. We'll keep them coming the first of every month, and enjoy the rest of your day.